Appreciate that. So first of all, welcome everybody. Thanks for being here from as far away as Berlin, Germany, which I might add is one of my favorite cities in the world, and I will be back there as soon as I can start to travel again. I see people from the island and around Vancouver too, so that's great. Thanks for coming. My name is David Raffa, as Angie said. I've been in this business for a while. I'm going to just call out one thing right away at the beginning on the how and when to prepare. Normally when I do this presentation, it says how to prepare to achieve a strategic exit. I added when because the New Ventures VC competition and program is typically for very, very young entrepreneurs and young companies. And the classic thing that I hear from people when they're very early in their company is, well, it's way too early for me to think about. So what I am going to try to address in today's session a little bit is some of the things you might want to think about very early on, just to make it easier down the road when it comes time to exit. Please feel free to ask questions throughout the process. I want to make this interactive, and I'm also available even after the program's done if you have follow-up questions by email. My contact information is at the end of the presentation. Okay, so my background, I won't read it out other than to call out two things. Number one, this picture does actually remotely look like me as opposed to all the ones from the real estate agents that were taken 30 years ago, and then you meet them and you don't even recognize the person. I say that because I've just gone through both buying and selling a house. But I've been in this business for quite a few years. I've known Steve for a long time. In fact, was involved with launching New Ventures VC when it first started. What I currently do now is sell-side mergers and acquisitions for technology companies, but I've been an angel of VC, and I have been an entrepreneur in a number of companies as well. I break down the M&A process into kind of a 5-step process, and this is not linear. There's overlap in all of this. You're doing a little bit of all of this at the same time, other than maybe the last 3 stages that are a bit sequential. Obviously, the first stage, educate, is kind of what we're doing here in the session today, and I commend you on this because when I was a VC and when I've been on the boards of companies, it's often surprised me how many entrepreneurs don't understand the process of the exit, which for most of them, unless they're building a lifestyle business, is their ultimate goal. And in fact, if you think about it, the single biggest decision you'll ever make with your company is when you come time to sell it. It's more important than every other decision you've made before because it's the final decision. So hopefully today I'll provide a little bit of background education for you. So what I'm going to do in the presentation today is kind of go through these 5 stages: educate, analyze, prepare, market, and close. The deck's quite long. If we run a little tight on time, the closing one speaks for itself, and I'll just let you read that because I really want to make sure we spend enough time on the first 3. So I'm going to jump into the first one. Educating yourself on the process. So there's kind of high-level things that you need to educate yourself on, and then the minutia. So starting from the high level, it's common things like that, probably questions that you're already asking yourself, like what could go wrong and how can I make mistakes, and how's valuation negotiated, and why do people get great valuations, and who are the types of buyers, and those kinds of things. I'm going to go through each of these bullets one by one through this presentation. And if you've got questions here that I haven't asked, where you want to understand in the process, please feel free, like I said, to jump in and ask them. So these are kind of what I call the higher level questions. And then there's some ones that are kind of minutia. What kind of financial statements will I need, taxes and structure and things like this. Each and every one of these, there's some very important considerations. And I'm going to give you some concrete examples of things that have both been done correctly as well as things that have been done wrong and people who have gone to sell their company. So I'm not going to speak to each of these here because we'll talk about them as we go through the presentation. Okay, so let's start with the first one. Who buys? And I break buyers up into these 4 kind of artificial categories. What I call strategics, or just think of that as enterprise buyers. And they would be the ones that you might think yourself would be the logical party to buy you down the road. So they might be customers, partners, competitors. or they might be in your vertical, whether they're selling the same thing or something different or something that's close to it. And the advantage of the strategics and why they're important is they're most likely to pay the highest price for you when it comes time to sell. Some companies even start off with identifying who they think that buyer is and building a technology specifically for that buyer. Classic example of that is there's no shortage of people who started companies up to sell to Microsoft or Apple or SAP or any of the big technology players, Google, where they've identified what they think is a gap in their services and they think they can build something that they might acquire. And there's nothing wrong with doing that. It is a strategy. Also very prevalent, and more interestingly, more and more prevalent every year are private equity and venture capital funds, although much more the private equity funds. 10 years ago, if I sat down with a strategic enterprise company that was talking to one of my clients about acquiring them, I would usually be talking to the senior people in that strategic company. They might be backed by a private equity group who is backing their acquisition strategy and possibly funding it as well, most likely funding it as well, but they would be in the background. Today, the private equity groups are almost always at the table and then sometime lead the process even more than the enterprise customer that they're backing. So I had an example of a company where we were selling it. It was located in Kamloops. Myself and the CEO and the controller flew to Manhattan to meet with the buyers. The buyers were backed by a private equity group and they had a buy-side investment banker. They had 23 people in the room and there was 3 of us. And the private equity people were outnumbered the number of people in the company in the due diligence discussions. So first thing I said to them when they came in the room is if it works, if this transaction negotiation is going by numbers, you guys already win, because we felt pretty small in the room, but it was ended up being a good result for us. Another type of, so why do private equity and venture capital companies buy? Well, usually because what they're doing is they're looking to buy either a platform company that they're going to invest in and build through acquisition, or they already have a company in their portfolio and they're looking for what they call a bolt-on or a tuck-in. So they're looking for a company that they can roll into an existing portfolio company, which will add value to that portfolio company. If you're small and being sold, that's more likely the scenario the private equity firm will talk to you. And when I say small, I mean sub at least 25 to 50 million US in revenues. You'd be looked at as a bolt-on or tuck-in rather than a platform play. Then there are special purpose corporations that have been created solely for the objective of buying companies. Consolidators or roll-up vehicles are the terms that use. And this is a great Canadian success story, because if you ask a lot of technology entrepreneurs who are the most likely buyers or the most active buyers out there, they would name Microsoft and Google and Apple and all the companies you'd think of. Yet year over year, the company that buys more software or technology companies than any other in North America is a consolidator called Constellation Software that was founded in Toronto, and that's listed on the New York Stock Exchange. They buy between 80 to 120 companies a year. And their goal is simply to acquire. And then lastly, if you're a smaller company, there's another group of prospective buyers for you. When I say smaller, again, think sort of sub 10 to 20 million in revenues. And they are search funds and entrepreneurs. And what a search fund is 1, 2, maybe at most 3 individuals who've had prior success, have a little bit of capital on their hand, and then have raised some money through their network to allow them to go out and find one company that they wish to buy and build. So, and there's lots of them out there. There's hundreds of them out there. Okay, why do strategics buy? It's important for you to understand, if you're marketing your company, what is the buy decision? Just like the way when you're selling your product, you want your salesperson and your marketing person to understand your customers and their buy decisions and who buys and why do they buy. You have to do the same thing when you're selling your company. And the most common, and this is actually, I did an update on this in the report that Angie alluded to. In the last year during COVID, the number one driver was product expansion. And a classic example of that, again, is a company with a local connection, which was Salesforce acquiring Slack. And Slack having been founded by Stuart Butterfield, who is originally from Victoria, and who founded initially Flickr, which was acquired by Yahoo. So that was pure product expansion for Salesforce and a clear indication that they want to start to encroach on the Microsoft world. Other reasons are, simply wanting to buy customers, and a few other reasons you can see here. Things like, you have a company that's got penetration into a geography that they don't have, and they want to get in there. And even in some cases, some buyers will buy you just to shut you down because you're starting to annoy them by virtue of your competitive advantage. It may not be why you'd want to sell to somebody, but it can often be a driver. And then I'm sure a number of you have heard the term acqui-hire, and an acqui-hire is really being acquired for your personnel. That's not normally a high valuation situation. The high value situation is the first bullet on this page, where you've got a product, technology, or IP that buyer needs. And that's where you can get those strategic valuations that you've often read about or seen online. Consolidators and roll-up vehicles buy for very different reasons, and they pay very differently because of that. They are running a very simple scenario that says, we want to buy you for $10 million because we're a public company, and if we buy you for $10 million, we know that we'll get $15 million worth of value added to our market cap in the public markets, because we're going to buy you for the lowest price we can, and we're going to try to trade at the highest price we can. So they are hard negotiators. They are working to grind value down, and they are not the ones that will give you the best value. You might ask yourself, why would you even talk to them? Well, a couple reasons why. I did a transaction where we had 5 offers, 4 from strategics and 1 from a consolidator. And we did this in order to establish the framework or the spread of the valuations. The consolidator was at the low end. That gave my clients the ability to know if in worst case scenario, they could get at least X for the company. The strategics were the ones who would pay the higher amounts, and the difference was quite substantial. The strategics were, 2 of them were more than 3 times the value that the consolidator was offering. So I always go to the consolidators when I market a company, because to me it sets the floor. And in some cases, sometimes there's no strategic out there and you just want to sell your company and you want to have an opportunity. Positive thing about them is they're professional, they're deal oriented, and they get their deals done. And there's low deal risk because they're usually funded to do this. PE funds and VCs, they could be somewhere between a consolidator and the strategics. They are in the business of investing in companies. And as I said, they'll typically buy companies for 2 reasons. One is, if you're large enough, they'll buy you as a platform. And by that, I don't mean a software platform. What I mean is a platform on which they're going to go out and start to add more companies to it to build a larger company. Or they may already have a platform company and they're looking for companies to add into it. And so when I market to the PE funds, in this situation, my clients, I work with small caps, so they're typically sub 10 million Canadian in revenues, but almost always sub 20 million in revenues, sometimes as low as 3, 4, 5, 6 million revenues. I will approach these right up front by saying, I have a tuck-in opportunity for you if you have a portfolio company that has interest. Because generally speaking, they don't want to acquire a platform company unless it's doing, as I said earlier, 25 to 50 million US in revenues. The search funds, high net worth individuals, entrepreneurs, they're actually looking to acquire your company to run it long term. In fact, they may never sell it. They may decide to run it as a lifestyle business. As a result of that, they're often looking for companies that are very EBITDA positive, which rules out a lot of early technology companies. But some of them will buy them with a view to flipping them down the road at a higher valuation. These are seasoned entrepreneurs who will think, I can do a better job maybe than those founders can because of my experience. Plus, I have capital available to me that they don't have. So I could buy the company today for a fair valuation, but I can increase the company, its size 3, 4, 5-fold, and then sell it. And companies sell at higher valuations the bigger they get, not just because they're bigger, but at higher multiples because they're bigger. So it's one of the things that you need to be wary of when you're reading online about what companies have been acquired for, which is the data has shown, and it's referenced in one of my reports, the highest valuations are given to companies that are somewhere between a 50 and 250 million US in revenues. Above that, they're starting to cap out. Below that, they're still considered a bit too small to attract the highest valuation. Okay, so who's involved in this process? Leaving aside the selfish promotion at the bottom bullet on the left, at a minimum, there's going to be your management team, and you're going to have to decide who is in the loop on this, because you generally don't want everybody in your company to know if you're for sale, because it creates stress within the employee base. So usually projects are given a code name to identify, to be used, and there's a clear distinction about who's involved. At a minimum, your CEO and your CFO, your board, of course, sometimes your CTO, or sometimes other senior management team members. And you will need legal counsel, auditors, and tax advisors. Most companies are audited before they're sold. Sometimes there's tax planning, and you need legal counsel. You've got one on this call today, Steve Lucas, who I've worked on numerous deals with, and he's one of the best M&A lawyers in the city. So you wouldn't go wrong by using him, but there's lots of people as well that have experience. On the buy side, they'll determine who that is, and it'll kind of be the same type of people. Although if it's a very large company, often they have dedicated people who do this kind of work, and they refer to them as corp dev. And as opposed to business development officers who maybe are forming partnerships for the company, corp dev are the ones who are charged with going out and looking for companies to acquire. They'll have legal counsel on their side. They might hire outside consultants to do financial reviews, something called a quality of earnings review, product technology reviews, and they may be represented by a buy-side investment banker. So I'm a sell-side investment banker. Often clients will have buy-side investment bankers. And then in many cases, as I said, their investors might be actively involved, maybe through a PE fund having invested and one of their individuals being a board member. And as I've said, over the last 2 years, I've seen the level of involvement of the PE funds go up quite dramatically. What can go wrong? This is a big one, of course, and something everybody's a little bit concerned about. So some things you can obviously identify. Failing to get the deal done, exposing your trade secrets, your customers, partners, your IP, having your staff get nervous. I would love to tell you that there's a way to minimize, to eliminate all of these risks. There isn't. There's a way to minimize the risks by being organized, by being very clear about what you're doing, and gating diligence with a buyer. Okay, but in this day and age, with everything online, it's very easy for this to get out there that you're for sale. So I've had examples where clients of mine have had competitors go after their customers saying, we hear that so-and-so is for sale, you should switch over to us. I've had situations in the past where I've seen staff members get nervous and one or two jump ship. I've seen deals stall with customers when they get wind that the company's for sale. I use mechanisms to minimize this. You just need to be organized and be cognizant of the fact that there are risks. Probably the worst one is if you're a small bootstrap company, you just get distracted from running your business and it suffers while you go through the process. Therefore, if you don't actually complete because you don't handle it correctly, you've now held back your business for a period of 6 months or so while you went through the process and not complete it. And so there's a bunch of things to mitigate against that, one of which is simply being really organized. Okay, the big one that everybody wants to know about, maximizing valuation. Okay, Here's a very, very simple idea of evaluation. You've heard the term financial multiple. It can be a multiple of your revenues, your profit, or your EBITDA. I do a lot of software company work. Often revenues are used as the multiple. I provided a very simple example. Revenues are 5 million. The multiple is 4 times revenues. Therefore, your valuation is 20 million. That's simplistic. It will never be that simple. Okay. I'm going to show you a little bit of a parsed example about what it might look like, but I will talk about lots of the things that will drive value in your business and how to maximize value. So if you're not highly if you don't have a high revenue run rate yet, or you're not profitable, there's lots of other things that can be pointed to for valuation. And it's really a good idea in advance to go through and think through each of these. So, these are not what you want to sell for, because these tend to be the lower valued metrics, but each one can be accretive and they can be used in setting at least the baseline. IP, though, can be very strategic and be highly valued. And market penetration. Good example, market penetration is Facebook bought Instagram for $1 billion. When they bought Instagram, Instagram had no revenues, it had no revenue model, and it wasn't doing the advertising that it's doing today. They were bought for one reason and one reason only, and that is they got ahead of Facebook in capturing user share on the handset. And so Facebook had two choices: to try to outcompete them for that space on the handset, or to buy them. And they did. And when they bought them for $1 billion when they had no revenues, a lot of the analysts said, Mark Zuckerberg's on crack. This was the stupidest thing ever. What a terrible deal. And within 5 years, people started to say, one of the most brilliant moves Facebook ever did. So there's lots of different things that can go into it. You should think through from your side what you think you have to offer that will allow you to build value. Let me take you through an example of a valuation for a SaaS company. And I apologize, I'm focusing on a SaaS company, but they're different for every different company. So I certainly can't provide an example for everyone. So some of the things that will be looked at in SaaS companies is the percentage of recurring revenues is very important. Churn is also important. And LTV to CAC is lifetime value of the customer to customer acquisition costs. And you may or may not have heard of something called the rule of 40, which is it's okay not to be profitable if your growth rate's high. And if your growth rate's lower, but your profit's high, that's okay. The sum of the two should be above 40. So as an example, if your average growth rate was 30% and you had 10% EBITDA, then you're at 40% combined, you've met the rule of 40, okay? Average contact value, sales cycle, and a whole bunch of other attributes that kind of come into it. Churn's a very big one for recurring revenue companies, because what buyers are looking for in this situation is, and the pitch that I'm looking for and the type of clients I like to sell to big companies is, I want to say to the big company, my little client only has 5 million in revenues, but guess what? 95% of them are reoccurring, and they only churn 3% a year, and their NPS score, their customer satisfaction, is extremely high, and their lifetime value for each customer is long, and their cost of acquisition is low. This is a great company as proven by those metrics. You, large company, have the ability to do what my little company can't, and that is grow faster, because you have capital, you have distribution, you have a fully built marketing department, a fully built sales department. What you need is a good product to sell, and I'm going to show you metrics that say my client has a good product. That's how you get a strategic valuation, and that's where the fit happens. Okay, so let's take an example of a SaaS company doing 5 million in revenues, okay, of which 85% are reoccurring, 7.5% a one-time launch fee, 5% custom development work, and 2.5% hardware sell-through. I've given you some other metrics on here. I'm not going to read them all out, but I did want to call out those first ones because I'm going to use them. So the rest of the metrics here I'm presenting would be considered good, and in some cases very good. So this would be a company that would present well. And this is the stuff that you need to compile before you go to market and be able to present. Now we apply the multiples, but we apply different multiples to different portions of the revenue mix. So I took those percentages and applied them to the $5 million to get the portion of revenues. And then I applied what would be typical multiples that might apply to each of those. The recurring revenues get a higher multiple. The one-time launch fees, much lower, but higher than the custom development work. You might say, logical question would be, well, if both of those are simply services somebody's providing, why is one 2x the revenues and why the other 1x? Well, the 1x for the custom development work is because my client has said to me, yeah, David, we charge out our custom development work at $80 an hour, but it costs us $60, so we don't really make very much money. But on the launch fees, they say we guarantee them 20 hours of service, but what they don't realize is we've created a mechanism to launch their product in an hour. So that's actually extremely high margin business for us. So we're going to give it a better valuation.
Oh,
and
hey,
then
David.
The hardware sell through typically is low. In this situation, that same $5 million company broken down like this, instead of being worth $20 million, is worth over $25 million. This is just an example. There could be lots of other things that can come into it, but this is how it might break down in a negotiation. And again, what you want to do is have all of this information to be able to share so that you can do that exact thing.
David, quick question from Yoni asking, is the profit loss completely ignored here?
So that's a very good question. So that was the rule of 40, which is if the company is losing lots of money, yes, that's a problem. And ideally, you should be cash break even before you launch your company to market. But if you're a young company, most buyers understand that you are not trying to drive profit. What you're trying to drive is increase in enterprise value, which can look like a number of things. Increasing your MRR on a monthly basis, adding intellectual property, building out the team, adding partnerships, increasing the number of customers, reducing customer concentration. I often say when I'm talking to a private equity person, my clients are not profitable by design. And I wait to see the reaction to it. If they say, oh, I get it, then they understand the world of venture. If they don't get it, then some education is required. I'm going to talk a little bit later about the type of financial model we will show, and it actually goes directly to that point because it's a very good question. Okay.
And Justin had a question. I think he wants to ask it himself. Go ahead and unmute, Justin.
Can you hear me?
Yep.
Great. Thanks, David. Nice to meet you. Great presentation so far.
Thank you.
I curious about the two slides previous regarding the times multiples of revenue for a company that, for a company that was making 5 million in revenue. So could we apply the same methodology to forward, like pro forma metrics? So if you go one slide back, I think it was 19.
This one?
Yeah. So could we? So like, and I'm only asking because like, I'm building a SaaS company right now. And so if we're thinking about the same type of multiplier to come up with a valuation, could I use this as a forward-looking way for valuation, ignoring
Sure.
like a DCF and keeping in mind, of course, that we're a micro cap.
Justin, it's a good question. And as you can appreciate, with each one of these slides here, I could probably present 20 more slides on variations and things like that.
Sure.
To talk about. So a buyer will want to take these numbers from your last completed fiscal year and use those. A seller will want to take their forecast out to the end of this year. And in some cases in the SaaS world, if you're actually mature enough and proven enough, your forecast is predictable enough, you can actually go out to the end of this fiscal year plus the end of the next fiscal year and use those forecasts. More often than not, when I'm doing a negotiation, what it will be is your last month's run rate annualized. So not trailing
Got
12
it.
months, but your last months and annualized. So we'll look at what the MRR was for that month, and then we'll use what was the cumulative on the other 3 heads, and we'll come up with some kind of combination. But keep in mind, very few deals are done where somebody says, we've all agreed that the valuation is going to be a multiple of X, and now it's about getting to the numbers. These are things that are used going back and forth in the negotiation. And there are deals where formulas are built into the deal, so they become very concrete, but in most cases, that's not the case. And they're like statistics, which is everybody can find one that suits their purposes. So when I'm talking to the buyer will say, well, David, it's 3x this and 1.5x that, and we're putting no value on this. And then I'll come back and say, well, no, it's not right. I've got data that says it's 8x this and 5x this and 3x that. And we'll go back and forth. And what really gets down to at the end of the day is how much somebody's prepared to pay and how much somebody's prepared to sell for. And in fact, your question leads me into the very next slide, because the question I get asked all the time is, how do I get a strategic valuation? And so often I'm talking to an entrepreneur who says, oh, wow, I saw this company just like ours that sold for 17 times revenues. What I will tell you is, not having been in that board meeting, I can't say this for certain, of course, but I've been in those situations because I've sold companies for multiples well north of 10 times revenues. But what I can tell you is when we did, there was no discussion of multiples. The discussion was like what I talked about earlier, which is, here's what we have as a seller. Here's what you as a buyer can do with it. We've run a straw model predicting how much of our product you could sell compared to us and how much you could make because you've already got sunk expenses. And we know we're not going to be accurate and we know you're not going to share it with you. But what we know is it's a lot. Okay. And we want you to pay us something much more than a financial multiple for that because it makes sense for you to do so. And that's what a strategic valuation is. When you see somebody afterwards say, oh, it was 17 times revenues, all that means is, or 23 times revenues, or whatever crazy multiple, all that is somebody took the value of the deal and then they took the revenues and they divided one into the other and said it works out to this multiple. I can pretty much guarantee you that they were not discussing a multiple in the negotiation. What they were doing was focusing on what was the strategic value and what does that look like. So, have I answered your question, Justin?
Yeah, it was very helpful. Thank you.
No problem. Okay, next step, analyze. Okay, so this one's going to be a bit easier, which is one of the big mistakes companies make is that they don't actually analyze themselves, step outside the business and look inside to figure out whether or not there's some simple things that they could do before they go to market. So gap analysis. They're doing it on a day-to-day basis, but they're living in the business and they're not thinking this way. You want to do this because these are the things that are going to get picked apart in diligence. And so I encourage clients to do this, and I do a few exercises with custom clients which force them to go through this process, even though they object screaming that it's a waste of time and it takes too much effort and there's no purpose to it. And then they do it and they usually come back and say, yeah, it was kind of helpful. We identified some gaps or issues that we had that we need to fix. And I will actually talk about that exercise a little bit further down the road. So there's a bunch of kinds of things that you could be thinking about. Now, obviously, you can't do everything because you might be thinking of selling because you don't have enough money to do all of these things. You know it's going to take a long period of time. You can't access all the personnel that you need. But sometimes there are small things that you can do that can really change the value of your business. This is just a sample list of some of them. But a good example is I've had situations before where we changed the revenue model and the pricing strategy to attract higher multiples in a scenario where the client said, well, we've always sold this way. And I said, well, why don't we try this and see if they like it, because it'll change the way you're perceived of in the marketplace. So another really important one is customer concentration. I'm consistently seeing asked for by buyers, and this again is something I didn't see asked for a few years ago. Give me your top 10 customer list broken down. To the point I've had to create a tool for clients to put this together. they're very concerned if you have any customer typically above 10% of your revenues. And it's because of from your perspective, it's kind of damned if you do, damned if you don't, because if you have a customer that wants to buy more from you, of course you want to sell to them and you don't want to turn the business down, but then they're worried about the risk of losing that customer. So focusing on adding customers and adding geographical reach, even if it means, and penetrating new verticals, even if it means only a little bit of penetration, could be something that can really change the value of your business. One of the things I talk about with early stage companies, and I just work with early stage companies because I'm an ex-VC, is that so often they've been created and their early success comes from the force of personality of the founders who are working ridiculous hours, using connections, going after the low-hanging fruit, and they're clawing and scraping their way to the first couple of $1 million of revenues. And you will see, and venture capitalists will tell you this, you'll see so many companies seem to hit the wall somewhere in the $2 to $3 million revenue range. And the reason being is they do not have scalability, predictability, repeatability built into their model. They're flying by the seat of their pants. They don't have processes. They're not using the technology they should use. And the loss of any of the critical people will be a really, really bad impact on their value. So one of the things that I tell companies, and one of the things that I do if I work with a company, is we are going to build in scalability, repeatability, and predictability in before we go to the market. When you present a sales funnel to somebody, and by the way, if you're going out looking for financing and you do this, I can tell you that the very first thing that we did when somebody gave us a sales funnel with a hockey stick is we asked them for their sales cycle. We asked them to show us how they manage their sales funnel, the various different levels, how they manage conversion through the funnel, what the cycle was. And if the top of the funnel didn't spit out at the bottom of the funnel numbers that matched the forecast, then the forecast was complete bullshit. And so that's what I'm talking about by having built in processes and things like this. So this will help you in a sale, but if you're still at the stage where you're thinking about raising money, you got to get this right. Okay. Now, I talked about earlier on that gap analysis and the kinds of questions you should ask yourself. And I created a little document called a storyboard, but you don't need my document. You just need to go through and ask these types of questions. And they seem obvious, and most entrepreneurs do, but most entrepreneurs haven't done them as detailed as they should. Not all have done all of them, and not all have answered them fully. So I created a tool which is about 40 diligence questions that expand on these. And I give them to entrepreneurs. I say, go through and ask and answer these questions for yourself first. And it will tell you if you understand your story, if your team's aligned, and if you are buttoned up. And if you're not, it gives you the chance to fix these things before you're in front of a buyer and before that buyer starts to ask those questions and you're scrambling to answer them. And one of the things that's really interesting that I've observed coming out of this in examples that I've seen is often senior people in companies discover that they are not aligned in their thinking about what the company is doing and why and where it's going. And it's not, it's not because the people aren't smart enough. It's because they're flying by the seat of their pants so fast that they often don't have time to sit down and think about these types of things and ask these questions and spend this time. So the process, and that's just there's the first half of the questions. Here's the second half. And I think as you go through them, you'll realize all of these are important questions. I actually created these originally for entrepreneurs looking for financing, which is, I think you need to be able to answer all of these if you're going out raising angel or VC capital, not so much friends and family, because those people are investing in you because they believe in you, okay? And each one of these questions gives rise to about 4 or 5 more obvious ones, which is why at the end of the day, you'll end up with a due diligence questionnaire that's about 30, 40 questions long. So it's a good exercise for you to go through and do these types of things before you ever consider selling. Okay, the prep stage. Core diligence documents. Confidential information memorandum or a presentation. So that could be a written narrative document, looks like an offering memorandum. More typically in the technology world now, it's actually a long slide deck. It's not a slide deck meant to be presented because I've seen these decks be north of 100 slides long and then split up into different topics. The product, technology, roadmap, architecture, set of slides, slides on the market, go-to-market, market positioning, slides on sales, sales strategy, funnel, slides on all the various different metrics I talked about earlier on. What you do is that is your core document that you'll present, but you will do a presentation. What you'll do instead is take that document and shorten it down to a shorter presentation. Need to caution you because often people come in with preconceived ideas about this from what they've been told from the financing world. In the financing world, you're told to keep it as short and as tight as possible. So there's all kinds of presentations. I did one recently for Thai where it's like you have 5 minutes to talk or 10 minutes to talk, or you can have 10 slides and no more. In the M&A world, it's the opposite. The buyers are data hungry. So the shortest presentation deck I will ever use when we actually go online and do a presentation will typically be at least 30 slides long because they're there for a reason and they want to hear and they're prepared to listen. Few things that you need to think about. When you're a young company, you're not typically going to spend the money on an audit, but when you decide that you want to go to market thinking in advance about starting to audit your financial statements or at least do review engagement, and then the financial forecast. And this is what I alluded to earlier when somebody asked a question about profitability. If I'm working with a company, so that financial forecast will go forward 2 to 5 years, ideally at least 3. For the first 2 years, it'll be presented on a monthly basis. It'll be broken down not into OpEx, but to sales and marketing, G&A, R&D, and if you have a fourth category of expenses, that too. And you'll present 3 versions. You'll present the budget you're working to. If that budget's not profitable because you're still raising money or investing in it, you're going to take a version of that model and back out the things that you would take out if you ran out of money and you had to focus on getting to break even. And then you'll also present a straw man for a growth model, which is if somebody with more resources were to acquire us, what could it look like? And that's your hockey stick. And so if you have those 3 and a convincing discussion in your MD&A, which is the next bullet, explaining the assumptions underlying all of these things, then you don't need to be profitable and you can get out ahead of this issue. The metrics I talked about, and by the way, one of the decks that Angie referred to, which is also on my LinkedIn page, presents pages and pages and pages of example of performance metrics for software companies. Business diligence, things that are just obvious, all the various different plans. Interestingly enough, nobody seems to want to use business plans anymore. So, but they do want to see the individual plans, your sales plan, marketing plan, your R&D plan, and the various different operational plans you're using internally. There's a couple reasons for that. It sends a message to the buyer that you know what you're doing, which is very important if you want to maximize your outcome. But it also does another thing. It de-risks it for the buyer because they're always worried that in a technology company, the best assets walk out the door at night. So what happens if you quit 6 months after they've acquired you? Well, they'll feel a lot better about making an offer if you've documented what you do. So just like people document code, you can document your other operations. Types of due diligence that will go. Product roadmap, there's all the technical side. Usually you'll do a demo, of course. They'll look at the people and your cap table. And then, of course, there's the process of actually going out to market, which is the last part of this presentation. So I won't go through these right now because I'll talk about these in more detail as we go through them. So some of the main
David,
documents,
is
the
it okay?
SIM or SIP, if it's in slide, and the storyboard. The storyboard is basically those questions I asked earlier, where you actually write it up, ask the questions, and answer them. All your plans, your sales funnel. I talked about how your funnel should be based upon, should have intelligence baked into it, and your forecast should attach to it. Okay. For technology companies, these 3 items are very, very important. They'll want to know that you have a plan about where you're going. You don't have to have completed. No technology company ever has, because you're always evolving your product. But by documenting this, it's very important. Often deals won't get done because the architecture doesn't match up. I've had that happen many times, where somebody's interested in the product, but we're on a different tech stack than they are. And when they look at converting it, they just say it's not worth it. I talked about the historical financial statements that you would need, and I also talked about the forecast, the types that you would have. The MD&A is something that might be new to you. If anybody's ever been involved in the public markets, you'd be familiar with this, because when you're a public company, you release your financial statements annually. You must include with it this narrative discussion. And this is where you go through and you talk about what happened and why, and the assumptions in your future forecast and what happened historically. Here's an example. 2 years ago, you ran a big loss, but you also invested 3 times the amount in R&D that you had in the prior year, because you needed to do a massive product upgrade. You needed to move to a new platform and a bunch of product expansion. So you want to call that out, because if somebody just sees that big number and the loss created, it just looks like a negative. When you call it out and explain in a narrative strategically why you did it, now what you're pointing to is inherent IP value you built in the business. So the more you can explain what you did and why, the more value that can be used in a negotiation.
David, I think Susan had a question.
Yep.
Thank you. Hi, David. We've done our 5-year pro formas with our 3 different levels, and we've also got like a running budget of everything we're spending and what we expect to spend for the 12 months ahead of us. Would you recommend tying in your sales to that one? Because it seems like it might be difficult for me to tie it into the 5-year pro forma, even if it's month by month, without.
Yeah, Susan, that's a really good question. So yes, your funnel, the output of your funnel, whatever CRM you might be using for it, should actually feed right into your forecast. But depending upon your sales cycle, it's only going to go as far as your sales cycle, and everything after that really is your estimation. So obviously your funnel isn't going to tie into something that's going to happen in year 5 unless you have a 4-year sales cycle. If you have a 6-month sales cycle, then it's going to tie into the first year and might slip over to the second year. So the way that I've always looked at the forecast is year 1 and 2 should be somewhat predictable. Years 3, 4, and 5 are really more indicative of what would be the expense load we would expect to have to invest in order to serve this revenue ramp rate. And so that's the one thing it should answer. And the second thing it should answer is, how big is the market opportunity out there? How do I validate that these kinds of numbers can be realized? Because any science beyond that is really not, it really isn't there.
And do you tie it into your direct like pro forma so they update automatically to
Absolutely.
actuals? Or do
Absolutely. The document that I use when I'm marketing a company is shifting from forecast to actuals every month.
Okay.
So for instance, as an example, if I have a company in market, well, I have a company market right now this year. So right now, when we put that forecast together, it was at the beginning of the year when the budget was done. So 2021 was all forecast. Now it says January, February, March, April actuals.
Yeah.
And it's auto adjusting that forecast from May forward.
So I'm doing that in a separate document and then transferring it just simply because I've got the pro forma set up to have the 3 different levels. Is that okay to do as well? Or
absolutely. Absolutely. It's a question about having the data, not about a particular format. And when I work with a company, I say, here's some examples of what I want you to have. You don't have to use mine. I don't want to reinvent what you do. if you're comfortable with what you do, just make sure you have this information because you will get asked for it.
Thank you.
Okay, thanks, Susan. And then David, I've got a more kind of a general question, so you can address this now or later, up to you, from Yoni, which is really just, how does a young company who maybe isn't sure about their exit strategy yet answer the question, what is your exit strategy?
So you don't have to have a perfect answer for that, because there are a lot of different answers for it. And it will only happen over time. And so I don't think that's a problem. In finance, when you're raising money, you're always afraid to not have an answer for a question that gets asked. When you're selling a company, you actually want to do the opposite. You want full transparency. Something that's wrong or you don't have an answer for, or something that's broken, you want that to come out as soon as possible, because the worst thing that you can do is dodge an answer only to have the deal fall apart 6 months later when it finally does get asked and you're forced to answer it. So to me, and I've seen the exact similar situation with a pricing strategy. I was on the board of a company that was an angel investor in, and we had about 6 different pricing strategies. And we sat down in front of a bunch of investors and we said, here's the pricing strategies we're testing. And a bunch of them said, well, you guys don't know what you're doing. You're not focused. And it was a fair comment, but we had talked about it. And we had some smart people around the table. Or our lead guy in that area had been a VP at Creo, which was $1 billion takeout. And his answer was, this is not my expertise, it was his answer. His answer was, we don't know yet. We need to test this with customers. Well, the same answer applies to the exit strategy. There may be a variety that you haven't figured out yet. You will start to. All I would say is start thinking about them. That's all.
How about saying we're just looking for as much growth as possible, like not necessarily to exit? Is it a good answer for, while you're
yes, well,
in your first round? Or?
Yep. You'll often hear when you go to an M&A seminar, people will say, how do you get the best exit? And they'll say, well, you have multiple offers. And I always say, actually, it's a twofold answer. The first answer is saying no. In other words, you have a good plan, and that's part of what all this is about, is making sure you actually have a good operational plan, and you got a good, strong, growing company, and you're financing, you know where you're going. If you look at all these different documents I talk about, they all speak to those issues. And part of what I want to show to a buyer is we don't have to sell. That's your best negotiation, okay? Then your second best negotiation is you're saying that same thing to 5 different people who want to buy you. So it's make us an offer we can't refuse. So I agree, like build a solid company with a good plan. What I don't agree with is lots of people who haven't been in M&A, and I saw this when I was a VC. I would sit on boards with VCs who'd never been through more than maybe 1 exit, and I've gone in my career through probably north of 100. And they would say, oh, if you build a great company, the exit will take care of themselves. I don't believe that. People do, and I respect their opinion, but I don't believe it, which is, why would you not plan this, just like you'd plan everything else in your business? You plan your sales, your marketing, your R&D, given that this is the biggest thing you'll ever do with your company. So I'm biased that way, and I'll admit that bias. And I'm sure there's people who will take me to task and say that's wrong, but I don't believe that you should just be sitting back, waiting for it to happen. We're going to turn to the last 2 stages in that process I talked about, which is how and when to proceed. Whoops. Going back to my first slide when I hit that button. Go to market. So when to go to market? One of the questions that get asked a lot of times by entrepreneurs is, well, I don't plan to go to market for 5 years. And what a lot of them don't realize is sometimes your hand gets forced. And you will discover this, if you haven't already, that you will get approaches. And so one of the great ideas about being prepared in advance is being prepared to respond if you need to on short notice, even though you might choose not to go to market for years down the road. Some of the clients I've worked with for as long as 4 or 5 years, where it was as a result of inbounds that they wanted to deal with upfront, but with a plan to set milestones to not actually go to market to down the road. So you want to be able to sell when the time makes sense. So how and when does that happen? Well, it happens because maybe there's a consolidation happening in your space. Sometimes it's a risk situation, such as a significant customer or partner says, we're going to buy you, or we're going to go a different direction. And then there's what I call the unsolicited inbounds. So, and if you haven't each received them yet, you'll start to receive them. Well, you get a message from a PE firm or somebody that'll say, hey, I saw your company online, would like to know more about it, see if you're interested in financing. And then it'll be a PE firm will say something like, we're interested in companies that have at least 10 million in EBITDA. You'll think there's no, I'm not even going to bother talking to you, just ignore it. You need to understand that often that's just a indirect way of trying to start a discussion, because they may not be looking to invest in a company that has 10 million in EBITDA. They may be invested in a company like that and are looking for add-ons. So these are conversations you want to have and you want to take, because they may yield something that makes sense for you. So, but you want to be ready before you do. So we're going to talk about that. Okay. So what is that exit plan? So, the exit plan was asked earlier on, and I think it was probably directed about, who should buy us? But these are some of the questions that you can ask, and you don't necessarily have to identify all the specific buyers. They're just pretty obvious questions, looking around your ecosystem and segmenting it and looking at the who, what, where, when, and why will help you as you're developing your plan going forward to make sure you're doing the right things. It'll stop you from making partnerships with companies that will limit your ability to exit. It will stop you from making mistakes with being too aligned with one that excludes another. It'll make sure that you're in a position to know who to go to if somebody approaches you, so you can quickly bring other people to the table. So in maximizing value, you have to be in a position where you can move multiple prospects along in real time at the same time. If you can't, then you can't create that auction scenario. So it's no good to have a party offering you an LOI today and you've identified somebody else you should talk to, but the first time you're going to talk to them is 3 weeks from now. You're not going to be able to put those two offers against each other, because the one will have expired before then. The buyers will know it. They'll say, I'm not going to wait around for you to market the deal to other parties. You take or leave this deal. So being prepped allows you to bring other people to the table in real time very quickly. What you want to do is sit down and develop an outline for a process for yourself, to understand, to think about how you're going to do it, when you would do it, what you're going to show people at what stage of the process in order to protect yourselves from the things, the data that you don't want to show, your IP. You're going to want to think about what your offer should look like, because somebody throwing a number at you is only one thing. There is the liability interrupts and warranties. There is how the valuation breaks down into multiple heads. There is how working capital adjustments are done, which with recurring revenue companies can, on a company that's doing $5 million a year in revenue, can swing the valuation by millions of dollars because of the deferred revenue charge you'll show on your balance sheet. You want to work through all these things in advance. You've got a working script and a working methodology for moving a buyer through the process. I'm going to talk to you about how, if you were organized to go to the market, so that you're not responding to an inbound, you're going to say, I'm going to build my company for 3 years. When we achieve these 5 milestones, revenues of this, profitability, this type of customer mix, this number of customers, this geographic penetration, this size of team, this kind of repeatability, we're going to make a decision to actively go to market. I'm going to take you through what that process might look like. This is the way I do it, and other bankers will do it different ways. And of course, by the way, you don't need a banker to do this. I talk about it from my perspective. You can do this anonymous yourself as well. And what I'm doing here is actually showing you how to do it. So when I do it, I start with a teaser that's sent out on a no-names basis. This will be about two email pages long, which will be a list of, it will talk about the company without naming it, saying it's a company that does the following things. It works in this market. It was formed in this year. It's about this size. Here's a whole bunch of financial and performance metrics on it. Here's what's special about it. Here's what we would make available to you when you sign an NDA. If you have an interest, get back to me and we'll go to the next level. And when we sign an NDA, I can let you know who the company is. That's your way of getting the word out, but without disclosing who you are. Okay? Usually what happens when you do that, and you'll build up your short list of prospects and a long list. I have a long list of about 1,000 contacts, and that's not individuals, but that's actually firms that will buy. But the reality is what you really want to do is identify a short list of somewhere between 20 to 40 top targets who are most likely to pay the most, and start with them first before you do a broad market approach, because it's a lot of work and a lot of those other buyers will pay low. So spending some time working on that list is really important in getting it right. Then once you set that teaser out to that list, then what will typically happen is they'll come back and they'll either, if I were doing it, they'll ask for a call with me first, just to understand the process and timing, and they'll try to get a number from me on what the company's expecting, to which, oh, by the way, you've probably heard this before, never, ever, 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 ever offer a valuation number upfront if you're selling your company, unless you're prepared to accept nothing more than that. Because all you've done when you've set that number is set the high water mark of what they might pay. They'll most likely then offer less. They're never going to come saying, well, you told me you want 10 million, I'm prepared to offer you 15 million. So there's no upside. And if you think, well, that's fine, I'll just offer a higher number then, you may offer such a high number that they decide not to engage. Your answer should be the following. If somebody says, how much do you want for the company? What you should say is this: I'm going to give you the materials you need to come to an assessment of value. If you make a reasonable offer and a fully baked LOI, we will treat it seriously. In that context, we will give you our feelings after having seen that offer. Not them throwing a number across where there's no LOI attached to it and not asking for a number for you. That's your answer. And that's why you want to have everything prepared. And nobody will object to that. Okay. At some point in time, that teaser will say, if you sign an NDA, and you should have a standard form for M&A, which is different than the usual one that you'll use, and try to get people to sign your form so that you don't have to negotiate every single LOI. You'll have to negotiate some. Once you sign it, then there's what I call the core DD package. This is not your full data room. This is a smaller set of materials that will be listed in the teaser, and the objective of those materials is to provide to the buyer enough information that will allow them to come to an assessment of value and be able to offer an LOI. Now, they won't do it just on reading those materials. They'll do at least 3 things. One is they'll want a presentation. They'll want the presentation deck presented to them, even though it'll be in that core diligence package. They'll want to see a demo of the product and technology, maybe more than one. And they will have some individual due diligence requests, due diligence calls, online due diligence sessions, but you may limit certain things. As an example, you may not give them the names of your employees if they're not public or not on your website. You certainly won't give them the names of your customers and partners. You'll anonymize them at this stage because you don't want to expose all of this stuff until you had an LOI. Because what if you expose all this stuff only to find out that they're valuing you at a quarter of what you expected, and you've now wasted your time and put yourself at risk. Okay, so then you ask for an LOI before you're going to give them access to the full data room where all your contracts are going to be, all your employment contracts, customer contracts, partner contracts, everything relating to your IP, and you're going to want the valuation specified in there, not a range. If they say, okay, the LOI says, we're prepared to offer you between $6 and $8 million, you can ignore the 8. They're not going to come back and offer you 7 or 7.5. They've offered you 6. So you need to read it the way it's been written. Okay, you want the valuation specified. Okay, and then there's a bunch of other material terms that should be included. They're covered in the last section of this presentation. May not have time to get to all of them, but you can read them. They're very easy. easily understood. I have a bias, and I'll admit my bias. I like long, detailed LOIs because my view is the deal is cut at the LOI stage. I've never been in a situation where we had a 4 or 5 page LOI with a whole bunch of terms, and then the buyer comes back later down the road as they continue diligence before we do the formal documents and go, oh, we would like to pay you more and give you more favorable terms. What can happen is the deal can go down, not up. So why you want to get it nailed down at this stage is you want to get it nailed down at this stage and then say to the buyer, your choice in the follow-on due diligence, if you don't like it, is to walk from the deal, terminate the LOI, or close. But what we're not going to have is deal erosion because buyers will play that game with you. And if you're well organized, it should never happen. So then they do follow-on due diligence because you've opened up the data room, legal work starts. You go through things like what's going to happen with the employees. I'll end up talking to other people. Then you have a closing, and then there'll be post-closing adjustments, and there may even be payments made out over time. So it can end up going on. I've had earnouts go out for 4 years. What you're trying to do, as I said, is get more than one offer at the same time. But you also want to look at other things, which is how clean the offer is, and what are the risks on the types of adjustments and liabilities, and certain intangibles, whether you want to continue on, whether you want good opportunities for your staff and things like that. Each one of these things is personal to the team and the company, but it's more than just a number. And you want to have in your mind what all of those things should look like. In order to get multiple offers and to be able to leverage them, I made this point earlier on, you've got to have everybody running in parallel, which gets back to being extremely organized. And then when you start the process, reacting in real time, being able to react in real time. I've had emails from buy-side investment bankers in New York City at 11 p.m. on a Friday night, my time, which means they're sending them out at 2 in the morning their time. That's how they work when they get going into in deal mode. And the only way that you can play one buyer off against another is if you all have them at around the same stage. And there's a real art to doing that. Okay, last section, closing the deal. And it's important to remember that do not rely on your bankers, your lawyers, your accountants, or whatever, and walk away from this once the LOI has been signed. It's your job to stay on top of this. They'll do their job, but you need to stay on top of this. Deals fall apart between the LOI and closing. And that is a catastrophic effect for a company because of all the effort, time, expense, the loss of focus on their business, and disclosing all of their information only to have the deal fall apart, and the public perception out there because it'll get around that the deal fell apart. So my advice is to ride the deal right through to conclusion. Okay. So earlier on, I showed you a list of steps that were 14 steps. And I told you about how at the LOI stage, that when deals cut. Now closing is from then on. Okay. And this is, I won't read these out to you, but you can see them very clearly. It's the same ones I said before, but it's kind of called stage 2 of the deal. You want to drive this stage through to closing. Keep in mind that once you have signed an LOI, you are locked up. The buyer is going to, you're not going to be able to talk to anybody else about selling the company. So that lockup period is going to hurt you. And at that point in time, they're going to start doing interviews of staff, partners, and customers. So now those parties will know that you're considering a sale because you're going to want to hold those things. You're going to want to hold your staff, partners, customers back to as late in the process as possible. But, you know, last deal that I did earlier this year, the buyer interviewed 21 different customers. And the results were great, but now the customers all know. If that deal doesn't close, you've now risked that. So again, it's why you want to make sure you negotiate the LOI clearly and you're very well organized so that there isn't something that's going to fall apart in diligence before you close. So what are the terms other than just the price that you want covered? Well, how and when it's paid. Okay. in what form it's paid, okay, how pricing is going to be adjusted, reps and warranties and the liability. These can be 20 pages long in a formal share purchase agreement. These are the representations, warranties that you're making about your business. What are the closing conditions? For instance, does the buyer have financing as the closing condition, and how realistic is it? Last year during COVID, this was a big problem. Buyers wanted to close deals and couldn't do it because their financing fell apart because the markets fell apart. What happens to all your staff members and other things as well that might be important to you? And this is why LOIs need to be detailed. On the purchase price, you've probably heard a few different terms. It's extremely rare that if somebody's buying your company for $10 million, they give you $10 million in closing. What's more typical is they give you some portion of closing. They then have a holdback for some portion of that, which is basically a little reserve so that if there's a breach of a covenant from you or there was liability under the reps and warranties you've given, they've got a place that they can go pull that money back and take it out of. Another form that might be blended in there is what's called the vendor take back. And that's basically, say somebody is buying you for $10 million. They might ask for a $1 million holdback, which means you don't get that on closing. They might then say, we want you to do a vendor take back for 4 years of $2 million. So basically what they're saying is, we want you to be our bank. We'll pay you interest over the next 4 years and pay you out that $2 million at the end of the 4 years. And then they might say, of that $10 million, we want $2 million to be earned based upon some performance criteria. So now that $10 million deal is $4 million on closing. It's quite different. And this is why the details really matter. The most common one that comes in is what's called the working capital adjustment. And there's typically two ways this is done. One is that as of closing, they take the working capital in your company, and for every dollar that it's above zero, they add it to your purchase price. And for every dollar that it's below zero, they deduct it from the purchase price. And they call this zeroing out the working capital. That's by far the least likely scenario. The way more likely scenario is that it's benchmarked against some threshold that represents your typical working capital over some period of time prior to closing that has to be agreed upon. And then there's every variation in between and other price adjustment clauses. I'll show you an example of this one. So purchase price of $20 million, current assets of 1.5, current liabilities of 750,000. If you are zeroing it out, it means you've got net positive working capital of $750,000 that gets added to the purchase price. This can be very material how this is negotiated, just so you know, especially with companies that have deferred revenue on their balance sheet, because that's a current liability. The more typical example is benchmarking. So again, purchase price is $20 million. And what's happened is you've sat down with the buyer, you've gone over your working capital for the last 6 months at the end of the month, and you've agreed that it averages around a positive $600,000. Then you get to closing, and your current assets are 1.2 million, but your current liabilities have gone up. You've incurred a lot of expenses. They're now $800,000. So your working capital is actually $400,000. It's $200,000 below the benchmark. That then gets deducted from the purchase price. And again, these can go into a lot of detail. You can end up breaking down the balance sheet about what you're going to include and what you're going to exclude and how you might value certain things. What is the cost of the deferred revenue? I think I mentioned earlier on today, for each one of these slides, I could probably add 10 more to talk about these, but I'm just trying to give you a high level. Okay, and then my last note for you, and this is the end of my presentation, is I always find it funny when we're working on this process and the clients tell me I'm too busy because I'm dealing with sales or marketing or I got an HR problem. And what I say is, look, this is the single biggest decision you'll ever make with your company. Every other decision you made, how you built your product, how you invested in sales, who you hired, the partnerships you formed, what you did, all lead to this one event, selling your company. So you owe it to yourself, and if you've got stakeholders, shareholders, your staff, to do it right. So my advice is whatever you do, treat it seriously. Okay? So here are some materials that you can download if you want some information that was referenced. Easiest place to go is just to my LinkedIn profile. And here's how you can contact me if you have any follow-up questions. And with that, Angie, I'm done. And I'm going to stop sharing, and I'm pleased to answer any final questions.
Awesome. Thank you, David, for the very, well, I would say detailed overview, as much as detailed as you get for 90 minutes, but I believe you do offer a more deeper dive on this other parts of the year with Angel Forum. Is that correct?
Yeah, with the Angel Forum, I do a version of this that's twice this length. So
Okay. Yeah.
that means 2 bathroom breaks for me, though.
Yes. All right. Well, it's 2:29. So we will first say goodbye to everyone. Thank you for joining us again. Tomorrow, 1 o'clock, we are doing Shred tax credits with EY. So if you are curious about how to gain free money or get back money, please do join us. Otherwise, thank you for joining us. David, if you've got about 5 minutes for if anyone does have questions, for those who want to stay, listen in on the Q&A or ask a question, we will do that now. But otherwise, thanks for joining us, and we'll see you soon. Okay, are there any questions? You can either, I'm getting lots of thank yous and comments about lots of homework.
I can see the chat now.
Okay, great. Oh yeah, you can see it now.
The
Great.
presentation. So
all right. Well, looks like
thank you all for coming. And if you have follow-up questions, please don't hesitate to just email me. I'm more than happy to answer them. So the reason I'm still working is I love entrepreneurs. I love seeing them be successful. Steve Lucas can't ask a question though.
Okay.
Rule.
All right. Well, it looks like Justin has another question. So Justin, go ahead.
Hey, can you hear me?
Yep.
Great. Thanks again. Thanks for taking the other question. You mentioned back in your slides gap analysis, and you mentioned, you know, when you're showing the hockey stick revenue, you mentioned a couple questions that investors, potential buyers will always ask. It was like 5 questions. I think the first one was how this company manages its sales cycle. What is your sales funnel? Do you remember the other 2 questions that you had that you need to be able to answer? I found those really insightful.
It was actually 18, and it's what I call the storyboard. And if you want to email me, which is in my slide deck, but it's david@davidraffa.com, I'm happy to send you any of you that document. And it kind of looks like a business plan, but it's not. What it is simply all the questions asked with a bunch of hints on how to answer it. And it's a bunch of work to do, but I'm happy to share it with you. I give it to you in Word so you can work it, and I give you a guide that goes with it that explains how to complete it, and it's a useful exercise.
Okay, perfect. I'm emailing you right now. Thank you.
Okay. Anything else?
Last call. Steve, anything you'd like to add other than applause?
All good here. Awesome, David. Much appreciated.
Great.
Thanks, Steve. I appreciate that.
All right. Well, I think,
Thanks,
yeah.
Angie.
Thanks, David, very
for
much.
taking some time out.
Yeah, thanks, everyone. And, you know, David provided his contact info if anyone wants to follow up. So everyone, have a great afternoon, and we'll see you soon. Have a good one. Bye, guys.